Most of the time the transactions were done at the base branch, and anyway banking was at a very nascent stage. So at that point in time, it was all based on prior experience. That's point number one, the heuristic approach, and all AML alerts or the suspicious transactions that we find at that point in time were all based on what the branch meant. Then came the requirement from the regulator and the various organizations, including the international ones which monitor AML, and they talked about getting some rules. So they said these are some of the rules, and if any transaction breaches any one of these rules, you need to dive deeper, understand, and analyze the transaction, and then basis your understanding, you can then go ahead and do AML reporting. Then came in the next concept of risk-based. So we said at the time when the account gets onboarded, you would give a kind of a risk, and the risk could be low, medium, high, whatsoever, and so on. But in the last 16 months, we have fast-tracked and moved to something different. We have moved to an algorithmic approach. So you have a set of rules, but are you covering all the rules? Are you managing within all the rules? Are you looking at the false positive rates of each rule? Now there could be some rules which could give you n number of alerts, but the total number of AML reporting that you do could be very, very minuscule. So you need to find methods and methodologies to work around it. Now the next two are the approach that we're going to use in the next few months, and I'll very briefly dwell on it. We are looking at new age cutting tools. We're looking at big data technology. We're looking at some platforms which could help us bind in all these factors, look at some scenarios where I could simulate some rules to see if which rule is better and what should I be doing for the set of customers that I have, and obviously the optimum state as you move on. This is the journey that we talked about. So 2010 we had the value-based transaction report which I talked about at the branches. Then we introduced a system which was very, very nascent, very, very rule-driven, and then came in IPA and they said we have some rules, every bank should have a uniform policy, which was very good because you wouldn't want to take a risk of one bank reporting so many and another bank reporting very few transactions. So that came 2014 brought in uniformity, and 2015 and 16 was the big phase for trade-based money laundering. And you would have heard about various instances of so many scams where money was siphoned off from the country in the garb of trade or trade that never happened. So trade-based money laundering is a new big buzzword. And you heard about the demonetization period, and you know the last 70-80 days since the start of demonetization has been very, very hectic for many bankers. And every day you get to hear something new or not. So 2016 was a time when Axis Bank shortlisted one of our business partners, and we said, no, we need to move away from this. So we required ability to change rules, we required ability to write new rules, we required some artificial intelligence to be built into the way we worked. Because when I was heading the unit, and something which I felt, there were some set of people who was always, and it happens in every organization, the first time when somebody joins a team, he's put onto the most arduous task. So he does do the sifting of, say something like 100 alerts, and then you will not find anything worth reporting also. But then there are other people who will just pick up all the alerts, and he will have a strike rate of 20:1 or 10:1. So we said no, we should get some more intelligence into it. So we got some intelligence to work on it, and this gave us a better strike rate, one. And what it also allowed us was, every day there used to be a small backlog of alerts that were left out. Because you cannot predict how many alerts will come. And though you can always say that on weekends I will have so much of transaction volume, I will be doing so much on a month end or a quarter and so on. But you cannot very precisely predict in the banking environment. Because you have a festival, you have an external factor of a holiday happening, and suddenly you will find a surge in transactions. So we came up with some scenarios and we said, let's run this in such fashion so that we can be a little more predictive about what we want to do. And last quarter of 2016, we just started the implementation of Jakarta, and I think Jakarta also brought in the demonetization for us. Yeah. So we went on from there. So in the constant game of volumes and expanding horizon, new products and whatsoever, our key focus was to make this whole product offering very, very simple. Keep the whole thing very simple. Tell the team that you have Sony volume. This is how you need to work on. And whatever you had taken as a decision in the past was stored somewhere and was being used to your benefit. So if your next desk member had taken a decision on a particular set of transactions, that was made available to you so that that could hasten your decision process. So you need not go back and invent the wheel again and again. And that was one of the approaches that we did. And we also then helped, by doing this, it also helped us get newer products into the fold. A lot of new lending products and other products started coming into the AML space. TVML was a bigger one. Yeah. So we leverage analytics and give us quality alerts. So quality alerts give you an option of reducing your false positives. What do you mean by false positives? You have a scenario where you look at 100 alerts, but you file only one report. That means you have a 99:1. Now if you can reduce a 99 to 1, you can actually spend more time on those alerts. So you can use artificial intelligence to help you out in sifting roughly 30 to 40% of those 99% out, based on your past pattern, based on your past transaction history, and that can actually help you focus more on the balance 50 that you have, and that will give you much better reporting. Okay. Enhancements, we did assess the impact of threshold revision, developing new scenarios that obviously gave us better results. There were a lot of scenarios which would never give us any results or any outcomes. We felt that though they were standard ones across the industry, they did not help us. So we moved them out, added better ones or modified them. And obviously the transformation was to leverage machine learning and do things a little differently. Yeah. So around this time came in a new animal of dynamic risk rating. So earlier we used to do risk rating of a customer when he was onboarded, and then at a later point in time when there was some significant event that was happening. But then we decided that we will adopt a quarterly based approach. So we said we will do a dynamic risk rating of a customer every quarter. So there would be 7 to 8 parameters which will be very independent of each other, and they will arrive at a decision, and that will tell you that this customer moves from a low risk to a medium risk or low risk to a high risk. Suppose I find a STR, obviously the customer becomes a high risk, but then along the high risk I need to be doing some set of transactions. I need to be doing certain set of monitorings, and those would help me do that. We then got into look at the transaction details. What causes this spike in these customers? Is it periodicity? Is it the value? Or is it the complexity of the transaction and so on? And then we started segmenting customers based on these set of findings, and that actually helped us do things differently. Yeah. Yeah, sure. You want to chip in? Okay. So currently in our journey, I would say between 1 to 10, we are somewhere at around 6.5. The next 3 or 4 months, we should see doing much more. So we are going to come to a stage where we are going to be a little better predictive. We are going to be a little better in terms of monitoring our things. And obviously we are going to look at the 360-degree profile of the customer, complete thoroughness, one. Number 2, look at enhanced products, and obviously adopt more into the AML space. So that's what I have. Over to Prashant.
Thanks, Shailesh. So when we were chosen to work with Axis Bank on this, on the vision and the mission that they had for their compliance needs, as a startup, I mean, we're 5 years old, but we still call ourselves a startup. One of the challenges was to make this work at scale, right? So we're looking at almost 80 million customers or their transactions. I mean, they add anywhere between 25 to 30,000 customers on a daily basis. So, I mean, the challenge is to make whatever technology that you're putting in work at scale to the size of the bank. So, I just want to go back to a couple of slides. So, when they wanted to move to a dynamic risk rating, and I mean, for me, I've done most of my work outside of India with large global banks. And so, one of the challenges was, how do I make my risk rating truly dynamic? So, while they as a policy decision may choose to do risk rating on a quarterly level, once in 6 months or whatever the policy dictates. For us, from a technology perspective, that means, can I make this in such a way that the customer risk could also change daily if required? Or if someone wanted to run this process daily across 80 million customers, can I reflect that change in almost near real time? And one of the reasons is because, I mean, we all know changing customer behavior, the expectations of the customer, everything is getting digital. So the ability of a financial institution to be able to react to this change efficiently in almost near real time will be something, something that Kavik said this morning is, this has to be part of business, which means, can I be there either in a predictive fashion, or can I be there almost when the transaction is just about done, right? And how can I facilitate that? So how does someone build a risk model, right? So even as basic, I mean, a lot of people have talked about risk, but in this case, like, so I build a lot of models for a lot of financial institutions, and in fact, entire industry segments, and things like that. But even if you were to strip it down to really, to basics, you can have high-level categories, and the category is just a description of that, right? So you could have multiple categories there. Examples of categories are on your right. You could have variables. So each variable would be, the type of customer you're dealing with, how long he's been your customer, what industry, occupation, what is their level of compliance within the organization. So you can define certain variables, but now the key factor is the risk factors. But these have to be things that you can actually pick out of existing systems. There is no point if these are descriptive to a level where, you cannot put in technology to be able to read these and score these automatically. So the whole point of actually breaking this down into this way is to come to that most granular element where the answer on an account opening form or as an interview relationship manager or any of the data is actually inputted can automatically be read, processed and scored so that gets into the model. So for us that challenge is how do we actually enable doing that? What that looks, so a translation of this into what the policy, so again, you should be able to demonstrate to business, to management, to your regulator, to your internal, external audit teams, what the risk of my customer is. So the implementation of the previous model is actually here. So customer demographics, I can take a lot of data points across. We all have legacy systems, we all have old customers, we've not been able to remediate them, we've acquired different businesses. So I have to put in default values or values that I know could break my model, right? And yes, and in fact some banks have been creative about this where they've actually taken higher values for data elements that are not present, so it puts pressure on the branch manager or on the business to actually go get that piece of information so that that particular risk variable actually comes down with the right categorization for that particular risk model. So there are different ways to skin that cat and different institutions use different methods and incentives or whether it's a characteristic methodology to actually arrive at what a risk model can do. But the idea is you should be able to demonstrate very clearly, very easily to someone what the risk of that particular customer is. Obviously, in this case, I can, end user can also override it with a maker checker and things like that. So I just wanted to give you a practical example of how you could build a model and use this across. So again, so how does all of this that some of the panelists were talking about, what Shailesh was mentioning, how does that translate actually in real life from a day-to-day and from a technology perspective? So one of the key features, there is too much vendor dependency or partner dependency to build rules. I should be able to go in as senior management and be able to just drag, drop, click buttons and create some of the most complex rules that someone would want to monitor. So the idea of providing, because there is no vendor who would say, I do not meet the requirements that are required, from a statutory level. All of us do, right? I mean, all of us that's what we want to help the banks do or the financial institutions do. But to Avini's point, how effectively, how efficiently are you doing it is what differentiates you. So the ability to create your own rules where someone just can click through and they can create their own rule sets. Simulate this data. I mean, if I put a rule in place, what is this going to really do to me, my team, and are they going to be able to effectively handle the outcome of what I'm actually going to put in? Because when we are talking scale, when we're talking 80 million customers and all of their transactions, if I put something in and my team is not able to actually close all of that, review all of that, a regulator is going to actually come and find it, right? So the ability to be able to simulate, look at statistical analysis to say, if I set my thresholds in these different ranges, what am I going to see? Does it actually make sense, right? So my platform must be able to sift through all of that data, all of those transactions in fractions of seconds to be able to show this kind of analysis to the compliance or the risk teams. Cluster or peer algorithms, right? I mean, what makes sense maybe in isolation or does not make sense in isolation might make sense when I look at it from a segment perspective, right? We see a lot of transactions